As of this exact moment on Wednesday, December 10th, 2025, Plug Power, trading under the ticker symbol PLUG, is changing hands at a live price of $2.20 per share. The stock is currently navigating a choppy intraday session, down approximately 0.45% from the opening bell, with the bid-ask spread tightening around $2.22 and $2.23 as volume begins to swell in the mid-morning trading hours. If you are watching the charts on your Fidelity mobile app or tracking the tick-by-tick movements on an interactive brokers platform, you are seeing a stock that is fighting a massive psychological war between total capitulation and a technical breakout. The market is flashing red, the sentiment is overwhelmingly bearish, and the general consensus on Wall Street is that this company is burning cash faster than it can print hydrogen. That is the expectation. But the reality is significantly more complex, more nuanced, and frankly, more interesting than the headline doom and gloom suggests. While the average retail trader on Robinhood might be looking at that $2.20 price tag and seeing a penny stock risk, the institutional data suggests something else entirely is brewing under the surface, a fundamental shift in business strategy that the market has not yet priced in. Most investors look at Plug Power and see a proxy for the entire green energy failure of the early 2020s. They see a stock that fell from the stratosphere, a cash-burning machine that has diluted shareholders repeatedly. That is the narrative. However, right now, as we speak, Plug Power is quietly executing a pivot that contradicts the bankruptcy thesis. The curiosity loop here is simple. If the company is dying, why are its electrolyzer sales up 33% year-to-date, hitting $124 million? Why is the Georgia plant, a facility that critics said would never work, turning out record production numbers with 97% uptime? There is a disconnect between the stock price of $2.20 and the operational reality on the ground. We need to examine why the market is punishing Plug so severely today, and whether the smart money, utilizing Fidelity Wealth Management Services, knows something the panic sellers do not. To understand this movement, we have to look at the immediate catalyst driving the price action this week. The tension in the stock right now stems almost entirely from the political shifts in Washington and the status of the Department of Energy loan. For months, the expectation was that the $1.66 billion DOE loan guarantee was a done deal, a lifeline that would secure the company's future infrastructure build-out. The reality, confirmed by recent filings, is that Plug has suspended activities related to this loan due to the new political landscape under the Trump administration. This sounds catastrophic. It sounds like the end of the road. But is it? When you strip away the fear, you realize that the market had already priced in this failure months ago. The stock trading at $2.20 reflects a company valued without government support. The contrarian take here is that by pausing the DOE reliance and pivoting to private sector financing and asset monetization, Plug is actually unshackling itself from bureaucratic delays that were bleeding its balance sheet dry. Let's analyze the trading behavior we are seeing on the screens right now. The volume is elevated, sitting over 17 million shares traded already, which tells us that hands are changing rapidly. We are seeing a classic churn event. Retail investors using SoFi Invest and Robinhood cash management accounts are likely exiting positions, fatigued by the constant volatility and the downward grift. However, if you look at the order flow, there is absorption happening at the $2.15 to $2.20 level. This is often a sign of accumulation by entities who are looking past the current quarter's cash burn. When you buy a stock like Tesla or Nvidia, you are buying a growth narrative that is visibly working. When you buy Plug Power at these levels, you are buying a distressed asset play where the operational assets, the actual factories and technology, might be worth more than the market capitalization suggests. Speaking of assets, we need to talk about the Woodbine, Georgia facility. This is the centerpiece of the reality that exceeds expectations. For years, the knock on Plug Power was that it was a science project, not a business. They could make fuel cells, but they had to buy hydrogen from industrial gas giants, selling it to customers at a loss. It was a terrible business model. The Georgia plant was supposed to fix this by allowing Plug to make its own liquid green hydrogen. The news broke recently that this plant hit a record production of over 300 metric tons in a single month. That is not a projection. That is physical product leaving the loading dock. The 97% uptime figure is the critical metric here. In the world of industrial gas, reliability is everything. If you're Walmart or Amazon and you run your forklifts on hydrogen, you can't afford a day when the fuel truck doesn't show up. By proving they can run at 97% reliability, Plug Power has validated their tech stack in a way that no balance sheet loss can erase. This is the coiled spring aspect of the analysis. The company is operationally succeeding just as the stock price suggests it is failing. However, we can't ignore the elephant in the room: cash. It is the bloodline of any company, and Plug Power has been bleeding it. The decision to raise capital through convertible notes and the at-the-market offerings has been painful for long-term holders. If you use a Schwab Intelligent portfolio or manage your own individual brokerage account, you know that dilution is the silent killer of returns. Every time Plug issues new shares to keep the lights on, your slice of the pie gets smaller. This is why the stock is at $2.20 and not $20.00. The market demands proof that the cash burn is ending. Management has guided for a gross margin break-even, but investors have heard this before. The difference this time, in late 2025, is the shift in revenue mix. The company is moving away from just selling the fuel, which is capital-intensive, to selling the equipment, electrolyzers, to other people who want to make fuel. It's the classic picks and shovels strategy. If the world wants hydrogen, Plug will sell them the machines to make it rather than trying to own every molecule of hydrogen itself. This strategic pivot is crucial because it aligns Plug Power more with industrial manufacturers and less with utility companies. When you look at the broader market, stocks like Fuel Cell Energy or Ballard Power Systems are facing similar headwinds, but Plug has the scale. It has the installed base. The 33% growth in electrolyzer sales is the green shoot in a forest of red tape. It suggests that despite the political headwinds against green energy subsidies, the private market demand for hydrogen, specifically for industrial use and heavy transport, is growing. Major oil and gas majors like BP and Gallup in Europe are buying Plug's tech. These companies don't care about U.S. political posturing, they care about decarbonizing their refineries to meet European mandates. This international diversification is a safety net that many domestic-focused investors on Robinhood stock trading apps might be overlooking. I want to pause here and get a pulse on the room, because this is a battleground stock. Comment below how many shares of Plug Power you currently hold and what your average cost basis is. Are you averaging down at these $2.20 levels, or are you waiting for a confirmed trend reversal? I read every comment to understand where the retail sentiment truly sits, so let me know your position. Now let's look at the macroeconomic backdrop that is pressing down on the stock today. Interest rates are the invisible gravity acting on all growth stocks. When interest rates are high, the cost of capital for building massive hydrogen plants becomes prohibitive. This is why you see investors flocking to cash-rich giants like Apple stock or Nvidia stock, companies that don't need to borrow money to grow. Plug Power, on the other hand, is capital hungry. The suspension of the DOE loan means they have to find money elsewhere, likely at higher rates or through more dilution. This is the reality checking the expectation of easy growth. But if the Federal Reserve signals any dovishness, or if the cost of capital comes down, highly levered names like Plug are the first to rip higher. It's a high beta play. You are not investing in safety here. You are investing in leverage to the cost of money. Furthermore, we need to consider the data center narrative. This is a newer angle that has not fully permeated the retail consciousness. We all know the AI boom is real. We know that data centers for training AI models consume ungodly amounts of electricity. The grid is struggling to keep up. This is where hydrogen comes in as a stationary backup power source. Diesel generators are dirty and face permitting issues in many zones. Hydrogen fuel cells are clean. Plug Power has been piloting stationary power solutions that could effectively replace diesel for these hyperscalers. If, and this is a big if, Plug can sign a definitive deal with a major tech player to power their data centers, the $2.20 share price will look like a historical anomaly. The market is currently assigning zero value to this possibility, viewing it as a